Hey, what's up, my friend? So, here's the thing, right? Is it possible, right, to trade without a stop loss and without blowing up your trading account? Because here's the thing, I'm sure many of you or you watching this right now, you know that yes, you can trade without a stop loss, but the downside to it is that there will come a point in time where you encounter a loss. And because you were trading without a stop loss, that loss is so huge, right, that it wipes out all your small little profits that you've accumulated along the way. And what usually happens is that you wipe out your trading account. So now, the question is it really possible to trade without stop loss and without blowing up your trading account? Well, the answer is yes, right? And in today's episode, I want to share with you 4 techniques, right, that you can consider, right? And you can even explore more about if it's something that, you think it's for you, right? So let me share with you the first technique. The first technique is a form of trading called spread trading. So many of you might not be familiar with this term called spread trading, but the idea behind it is that you are trading a spread. So what is a spread? So let me give you an example. Let's say, you notice that the price of Coca-Cola shares and Pepsi, they are usually having let's say a $4 difference in price. So let's say, for example, Coke is trading at $10, Pepsi is trading at $6. So there's a difference in price of $4. So let's say in future, Coke goes up in price to, let's say, $20 and Pepsi goes up to $16. Again, their price differential is $4. So certain markets, certain stocks, right, certain instruments, they have this kind of like a fixed price differential over time, right? So this price differential is kind of like constant over time. Of course, there are times where it can fluctuate up and down, and this is where a spread trader, right, can take advantage of it. So let's say, assuming, right, you know that Coke and Pepsi, their price differential is $4. And let's say one fine day you're looking at the charts right now and you realize the price of Coke is, let's say, $25. And the price of Pepsi is $20. So now the price differential is $5 instead of the historical $4 price point that they have, remained over the years. So what you can do is to trade this spread. So what you want to do is that you realize that now Pepsi is kind of like, undervalued because it's lower than it should be, the price point. So what you can do is you buy Pepsi shares and you sell Coca-Cola shares. Okay? You lock in this kind of like this so-called spread, right? So you buy Pepsi at $20 and you sell Coke at $25. So you expect this difference in price, right, to converge into $4, right, sometime in the near future. And let's say in the near future, the price does converge. Let's say, Coke goes up to $30 and Pepsi goes up to $26. Now their price differential from $5 has now converged to $4, and you will make a profit from it. And what you're going to do is that, since earlier you bought your Pepsi shares, now you're going to sell your Pepsi shares. You're going to sell your Pepsi shares, and now you're going to buy back your Coca-Cola shares, which you have, shorted earlier. So this is what we mean by spread trading. So this is, I would say, an advanced form of trading, but in this type of trading, you are pretty much trading without a stop loss because you're kind of like, I don't want to use the word hedge, but it's kind of similar. You're hedged because you buy Pepsi and you sell Coke, and you're kind of hedged in that sense. So this is what we call spread trading, and this is how you can also use this trading strategy or technique or methodology, right, to trade without stop loss and without blowing up your trading account. Second technique to share with you is buying call option. You can either buy a call option or put option, right? You don't have to worry about stop loss because the reason for it is that a call option, right, is a contract, right, that allows you to buy an asset, right, at a certain price in the future. Okay, so if anything happens, right, that contract that you've bought will expire worthless. So let me give you an example, a kind of like an example that you can relate to. So let's say you are currently, wanting to buy a house, and the house that you want to buy is only built, let's say, 1 year from now. So what you can do, for example, is that you can enter a call option, right, to buy the house. Let's say the house right now, you think it's the price is at $500,000. You can buy a call option to buy that house in 1 year's time that it will be built at $500,000. Of course, that call option won't be free. Let's say the call option cost you $1,000. Okay, so you buy that call option, which is that contract to buy that house, which will be built 1 year from now at $500,000. And then what happens is that, let's say 1 year later, that house, right, that you had, that you thought it will be priced at $500,000. Let's say the house has increased in price to $600,000. So right now, your call option, right, still allows you to buy that house at $500,000, but the market value of the house is now worth $600,000. So that's how you kind of make a profit, right, by trading that option, that call option that you have bought. So this is one example. And let's say 1 year down the road, right, instead of having the house price at $500,000, you have a change in mind, you have a change in financial decision. You don't want to buy the house anymore. So what happens is that the call option that you have that you bought for $1,000, it'll just expire worthless. Okay, so this is how call option works in the grand scheme of things. So you can see that if you were to, buy call options, buy put options, the most or the worst that can happen to you is that the option that you have bought, okay, will expire worthless. Okay, so this is not going to be true for all types of option trading, especially when you start shorting, trading naked options. So this is just very simple example where I talk about buying call or buying put option. Okay, so next one, let's talk about another technique that you can use, right, to trade without stop loss, right? The other technique you can use is what we call a time stop. So traditionally, most of you are familiar with using stop loss, right? It's at a predetermined level where if the price hits that level, you exit the trade. So a time stop works differently in the sense that you only exit the trade if certain amount of time has passed. So very simple one is, let's say you buy a stock when it breaks above the 200-day high. Okay, you can use a time stop, right, where it says that if this stock, right, doesn't go up, let's say more than 2% over the next 2 weeks, you will manually exit the trade, or you will exit the trade. So this is what we call a time stop loss. You put a time factor, right, to determine, right, when you exit your trade, to determine when you cut your loss. Okay, so this is what we call a time stop loss. And the final technique that I want to share with you is, it's not really a technique, but the reason why a time stop loss would work, right, is when you are trading without leverage. Because if you were to trade with leverage, right, then the time stop loss is it will be quite irrelevant, because if the market moves, let's say you use 1 to 2 leverage, okay, and the market dropped 50% against you, you are essentially wiped out. So even though you are using a time stop loss, right, but if you are trading with leverage, that time stop loss won't work as well. So if you want to adopt a time stop loss approach to your trading, you cannot use leverage. That's the key thing. So for example, if you want to trade stocks, you want to adopt a time stop loss approach, you cannot be using leverage. If not, right, if the market moves against you by too much, right, you could end up wiping your trading account. So that's the kind of the key thing, right, to share with you if you want to go with a time stop loss approach. Leverage is something that you I won't say you can't use, right, but you want to use it as sparingly as possible, right, because that will affect the drawdown, right, that you encounter. Okay, so with that, let's do a quick recap, right, to how you can actually trade without stop loss and without blowing up your trading account. Number 1, spread trading. Number 2, you can trade options. And number 3, you can utilize a time stop loss technique, right, which is different from the type of traditional stop loss that you're familiar with. But the key thing to bear in mind is that you have to not use leverage, right, when you are using time stop loss. Okay, so with that said, right, I wish you good luck and good trading. I will talk to you soon.